The European Central Bank surprises markets with larger than expected rate hike, its first in 11 years. Now, the last time the ECB raised rates was in 2011, and it caused the S&P 500 to go into a bear market and drop over 20% from the peak to the low. So we're going to talk about that and how this time around is so similar to what happened in 2011 and what happened in 2008 as well. On top of that, President young Biden has tested positive for COVID-19. It is said that he has mild symptoms. We also have jobless claims rising again in another sign that the labor market is cooling down. So we have a lot to cover in a very short amount of time. Hit that like button and subscribe to the channel. Thank you guys for doing that. And without any further ado, let's get straight into it. So first things first that I want to talk about, and the most important thing, yes, young Biden has COVID. That unfortunately is not the most pressing thing that we are getting today. As far as financially, Biden, he'll be just fine. The government, I mean, they got treatments for this shit, right? They're not going to give it to you guys. They're not going to give it to average people. Let's just be honest here. But the president of the United States, they got treatments for COVID. So he will be fine. It did cause a market reaction today. The markets were slightly neutral, down a little bit, down about 0.15%. And at the low, they dropped to negative 0.80% after this news about young Biden did come out. So unfortunately, that is not going to be a big market event unless something really bad happens. And then at that point, we probably have bigger fish to fry anyways. Now, the European Central Bank surprises markets with larger than expected rate hike, its first in 11 years. And why this is so interesting is what is happening right now with Europe, the European economy, and that's really the key to all of this. So the key points: the ECB had previously signaled it would be increasing rates in July and September as consumer prices keep surging. The Frankfurt institution had kept rates at historic lows in negative territory since 2014 as it dealt with the region's sovereign debt crisis and the coronavirus pandemic. Investors kept a key eye on details regarding the ECB's new anti-fragmentation tool, which is aimed at supporting those nations with lofty debt piles like Italy. So long story short, what they're doing is they are raising rates, but they are going to start buying more bonds from companies known as PIG, right? That's the abbreviation. And it is, right here, you guys can see Portugal, Ireland, Italy, Greece, Spain. They are the so-called PIGs, as you guys can see right here. So it's a little bit of tightening, right? Raising rates, but helping out the economies that are really not in a good situation. So it's kind of weird this time around, but it is following kind of what happened last time around during 2011. So this article, you really have to go back in the archives to find this. This is from August 29th, 2011, and they are referring back to 2008. And we're just going to read this first paragraph, and then we're going to kind of give you guys the gist of this. So it says, in July 2008, on the eve of the biggest financial crisis in memory, the European Central Bank did something both predictable and stupid. It raised interest rates. The move was predictable because the ECB's president, Jean-Claude Trichet, was an inflation hawk. He worried about rising oil and food prices and saw a rate hike as a way of tamping them down. But the move was also remarkably ill-timed. The crisis was already underway. European economic growth had slowed to a crawl, and within a couple months, the global economy had collapsed. Inflation had disappeared, and the ECB was forced to slash interest rates in an attempt to avert economic disaster. The July rate hike was like kicking the economy when it was down. One might have thought that the ECB would learn from the experience. No such luck. This year, Europe has been wrestling with high unemployment, slow growth, and a continuing debt crisis with the economies of Portugal, Ireland, Italy, Greece, and Spain, the so-called PIGs, struggling to avoid default. Given the situation, Trichet could have decided to keep interest rates where they were, as both the Federal Reserve and the Bank of England have done. Instead, the ECB raised interest rates in April and once more in July. Again, as if on cue, European economic growth stalled and the continent's debt crisis deepened, which has created problems for markets around the world. So basically, Europe has really bad timing, and they tend to, at least from recent history in 2008 and 2011, they usually start raising rates way too soon, and then they start to go way too aggressive, which is kind of what we're seeing right now. European data does not look good, and the ECB just raised rates 50 basis points. And before you guys say, no big deal, we've been raising rates, 75 basis points, this is going to be twice in a row. The US and Europe are very different. Europe has this debt crisis, and they've had this for a long time, but they also have very, very low growth. And some of the better European economies like the UK and Germany, they rely on the other countries because they export a lot of products to those other countries. And that's what this article goes into more detail on. I will link this down below in the description of this video because this article might be hard to find. I had to scour through different things. It is from August 29th, 2011, so it's not as relevant today, but it's very relevant in the sense of what is happening and the pattern that is being played out again. And here you guys can see the 20% drop we seen from July 22nd was the peak all the way until the low, which was October 5th. You did drop over 20% from the low to, well, from the high to the low. So it can really affect our markets, especially if there is going to be more fear about Europe and what is going to happen overseas. So I think that is one of the most important things to point out for the day, as well as that you do have earnings coming here in after hours. And a key earnings is actually going to be Snapchat. Now, why I say this is actually going to be key and important, it's not because Snapchat is this huge company. That's not the case. I say it's going to be important because Snapchat is advertising. Snapchat is reporting before Facebook, reporting before Google, and even before Amazon. Amazon particularly, their segment of their business that is growing the most is AWS. A lot of that is based around advertising, right? So Snapchat, you're going to get a sense of advertising as well as subscriptions, and this is something that makes me very bullish on Snapchat. For those of you guys that are here, Snapchat has started to do a couple things over the last couple of weeks. Well, they have introduced a subscription model, and me personally, my sister, she bought the subscription and all of her friends did. So if I have seen that in my personal life, well, I'm sure it's happening elsewhere also, right? Probably on a big scale. They might have millions of people that signed up, and that is something, in my view, that the markets are not expecting as of right now. I don't think the markets are pricing in that this Snapchat subscription model will be somewhat successful, if not very successful, right? So you have that, and Wall Street's just older. They're not in keen with, what kids are doing with their Snapchat subscription models, right? So we will get more clarity on that, and I think that is going to be the bullish thing that really helps out Snapchat. But on top of that, Snapchat reduced their guidance about 2 months ago, 1 month after their last earnings call, and basically cut their guidance down to barely being profitable, if not losing up to $50 million. So the expectations are very low, just like Netflix gave us very low expectations last quarter. So it should be a lot easier to actually beat those expectations this time around. I personally did go with some options that expire next Friday, the $17 calls, bought those for about $125 a piece. And I also do have some August 19th $20 calls for Snapchat. Bought those at about $32 a piece. Those are up. Those are about $50 a piece right now. So there you have that. That's my trade. That's my theory on Snapchat. And I do think it should be a positive thing for the markets, especially because of a lot of stocks that are over $1 trillion, or Facebook, which is, definitely still up there. Those companies are revolved around advertising, and that is going to be very important, what Snapchat says as far as that is concerned. Now, we do have 6 days, 23 hours, 18 minutes away from the next Fed meeting, and that is where they are expected to raise rates by 75 basis points. About 71% of market participants do expect a 75 basis point rate hike. So that is key. We also have the yield curve, which is still inverted, 22 basis points, still inverted, the most we have seen since 1989. So I think that's important to point out. It might force the Fed's hand, and that is something that could make the markets very, very bullish. Coming next week, next Wednesday, the Fed will likely raise rates, but I think they will slow down. I think they will signal to markets that they are going to slow down raising rates, if not pause raising rates, for a period of time to see how the data starts to come in. Now, they have been saying that they're not going to do this until they see solid signs that the data is coming down, or inflation is coming down, I should say. But I think they are forced to by what the yield curve is doing. So keep that in mind. I think the yield curve is very relevant to what we are seeing right now. As far as the Atlanta Fed GDP Now tracker, we are still estimating we are going to get a negative 1.6% GDP print coming on July 28th. So you're going to get the Fed next week, the 27th. You're going to get the GDP print, the 28th, and then you're going to get Apple's, Google's, Amazon's that report earnings next week. So that week, the end of July, is going to be the most important week of 2022 for the stock market, and that is going to dictate, hey, are we going to be bullish, or potentially are we going to be bearish? And I think it all revolves around the Fed and what they say as far as the course of raising interest rates, because after this 75 basis point hike, we are going to be, in between 2.25 and 2.5%. That is considered the neutral rate. The Fed has talked about going even tighter than neutral, going into restrictive territory. But I think it's possible, like I said, that the Fed will say, hey, we have to let families' balance sheets get up to par with what we are doing as far as raising interest rates. They have killed the real estate demand. I'm sure they are killing auto demand. Just basically anything that involves a loan, the Fed is really getting that demand destruction. So you have that, and you also have the markets that are starting to price in a recession for 2022 as well as 2023, and that brings deflation. So depending on, what the course of a recession is, or how far along potentially we already could be in a recession, that will also help to force the Fed's hand. Now, as far as the day right now, the markets have since rebounded from the news that President Young Biden has COVID-19. We are only down 0.1%, sitting at about 394.27 on the S&P 500. Our favorite stock, which obviously is AMC. AMC is down about 0.80%, still on a very nice upward trajectory, and we actually did hit $18.37 per share, which was Friday's price target by the end of this week, in between $18 and $20 per share. And I do think Snapchat will have good earnings, and I do think that will send the markets up. Just keep that in mind. It's only my opinion. And if you guys want to come trade with me live in real time, get a more in-depth, explanation of all of these things, your link to do that is down below in the description. Prices will be going up again, so make sure you guys take advantage of that. I think it's going to be a very pivotal earnings for Snapchat, but as well as that, the overall market. So a quick look at AMC and the actual data as far as Ortex. We do have 10 orders for the day, totaling $929.2 thousand, positive order value of 66%. Short interest sitting at 18.63%, estimated value of the short interest at 1.68 billion, shares on loan 140 million, cost borrow 10.23, days to cover 3.36, 100% share utilization. You do have a cost bar max of 11.38%, cost bar average of 10.36%, cost bar minimum of 9.56%. So that is going to wrap up this video. Hopefully this did provide you guys some clarity to the events that are happening today and why the markets are somewhat bullish, somewhat bearish, and it's kind of a confusing time that we are in right now until we get more data, until we get more clarity from the Fed. So thank you guys for watching. Hit that like button and subscribe to the channel. Like I said 2 or 3 times in this video, if you guys want to come trade with me live in real time, link down below in the description. Until the next time, you guys enjoy the rest of your day. I will see you in the next one.